The concept known as the investor's pyramid symbolizes a structured hierarchy of diverse investment tools, each categorized based on its risk and return potential. This pyramid-like model sorts financial instruments in ascending risk order from base to peak. Lower down, we find low-risk options, but risk heightens moving upwards. The pyramid's base hosts low-risk investment vehicles. These include savings comprising bank accounts and deposit accounts, which offer modest returns but are deemed safe as deposits are insured up to certain limits. Another low-risk instrument at the base is bonds. These are obligations issued by governments or corporations, promising repayment with interest at predetermined rates. Government bonds, typically seen as less risky, are backed by the consistency and reliability of government support. The investor's pyramid thus starts with safer, low-risk, low-return options and gradually ascends to riskier and potentially higher-yielding ones. Government bonds are often considered less risky than corporate bonds. Mutual funds. These funds pool money from various investors to invest in a diversified portfolio of stocks, bonds, or other financial instruments. In layman's terms, it's the collective effort of many to create a substantial investment pool. This pool is then tactically deployed into varied financial instruments for risk distribution and potential growth. There are different fund types to suit varying risk appetites. Bond funds primarily invest in debt instruments, offering a lower risk but also potentially lower returns. In contrast, stock funds invest mostly in equities, providing higher returns but with increased risk. Hybrid funds aim a balance between risk and return, investing in equities and fixed income securities. Mutual funds are diverse, catering to various investment goals and preferences. From aggressive growth funds to conservative income funds, there's a fund for every investor. ETFs, exchange-traded funds. ETFs, while similar to mutual funds, are traded on the stock exchange just like individual stocks. They often track an index or a specific sector and, due to their unique structure and trading flexibility, can offer greater flexibility compared to mutual funds. Stocks. Investing in stocks involves buying shares of individual companies, a practice spanning centuries. It means purchasing a fraction of a corporation, becoming a shareholder. Shares represent a claim on the company's assets and earnings. The value of shares fluctuates based on the company's performance and market health. This possibility for high returns attracts many investors to stocks. However, it also carries a proportionate risk level. Stock prices can change significantly, influenced by economic trends, political events, company-specific news, and financial reports. Next, we tackle alternative investments. This category is an umbrella term for assets outside the traditional stocks, bonds, and cash. It includes tangible assets like real estate and commodities, and intangible ones like cryptocurrencies. Hedge funds and other unconventional financial instruments are considered alternative investments. Investing in these can potentially yield high returns, sometimes surpassing traditional investments. However, they come with unique risks and may require more knowledge and monitoring. Moreover, private markets also are accessible in the form of private equity and private debt. These forms of investment may provide higher returns, but they come with higher risk as well. Specifically, private equity constitutes an alternative to classical public stock market and consists in buying shares of non-listed companies. We may speak of venture capital, growth equity, or buyout depending on the grade of risk we are willing to bear. On the other hand, private credit may diversify your sources of income, while also lowering the correlation of your portfolio. The investor's pyramid proposes that a well-rounded financial portfolio should encompass a blend of varying financial tools to strike a balance between risk and return. This concept helps steer investors in their decision-making process. In the ever-changing financial market, this pyramid approach focuses on diversification of investments to reduce risk. An advantageous strategy is to allocate investments among different assets like stocks, bonds, real estate, and cash equivalents. For instance, those with a long-term investment perspective may be inclined to take higher risks and invest in stocks or riskier financial instruments for substantial returns over time. This strategy could be rewarding, but it's crucial to understand the inherent risk involved. However, the pyramid is a fundamental guide and should not be the only basis for investment decisions. Choices need to be based on an in-depth analysis of an individual's financial standing, goals, and risk tolerance. In this context, a financial advisor or industry professional's advice can be beneficial. They can aid in crafting an investment plan tailored to suit personal requirements. However, it's essential to note that the investor's pyramid is a general model, and investment decisions should be based on a thorough assessment of one's financial situation, goals, and personal comfort with risk. Consulting a financial advisor or industry expert can be helpful in developing an investment strategy tailored to individual needs.